the strategist of Barometer Capital Management, about his thinking. David, good to see you.
Great to see you.
Days like the last few are those moments where you start to wondering, we're getting deeper into the bull market. Is this the point where everybody's starting to say tech is too stretched? Where would you say it feels like we are in this market cycle?
So, the NASDAQ 100 has sort of lagged since June or July of last year. And, there's some great companies. There's 7 stocks that everybody owns, and they've been lagging sort of since December. And so you have to keep that in mind. We're coming into this earnings report tonight for NVIDIA, which is obviously a well-loved company. We no longer own it. We really have backed away from technology. We're about 6% technology across the firm, which is a huge underweight. It's about 28% of the S&P. And it's partly because there are other things to do. There's other parts of the markets, financials behaving really well, some global stocks performing really well. And so I don't love the fact that the technical setup is weak coming into these earnings tonight. Hopefully, they'll blow the doors off the earnings and really wow everybody with an outperformance. But the technical setup suggests that maybe it's a little more risky than it has been over the last while.
I do want to stretch beyond tech, but I have to say, anytime I start listening to some podcast on how AI is going to change the world or this and that, I sort of have this pause moment where I'm like, well, I get it that the valuations look a little bit rich, but if this is going to be so transformational, how far removed do I want to be from game-changing technology?
Yeah, no, I understand. And it's a very tricky one, right? Because we all see the opportunity longer term. The question is, where will the money be made next? And it may not be in the build-out. It may be in the application of AI technologies, in software companies and other areas. So we have to watch all that. I'm just saying that it's not the only place to be.
Okay. Now, when I look at the TSX over the last 6 months, tech has been the strongest performer over that period. But as a lot of our audience knows, it's not the most influential group for the Canadian market. And you mentioned financials performing relatively well. They've had better performance over that stretch than the composite itself. Materials, obviously, we've talked a lot about gold, and we'll talk a little bit more about that later. Yeah. But when you look beyond tech, what do you see?
So when I look beyond tech, we always look for a sector backdrop that's supportive of the stocks that we wind up owning. And for the last 2 years, financial services have been really the most consistent outperformers, not just in Canada or the US, but globally. And that's after, close to 15 years of no performance following 2007. So they benefit in a world where inflation is a little more sticky. And inflation has been a little more sticky. In fact, is ticking back up over the last 3 months. And these companies benefit in that world. So whether it's insurance companies, property and casualty companies, banks, capital markets, investment dealers, exchanges, they've all been performing well. Even European financials are on a tear right now. And so you've got a really positive backdrop for investors in this area.
Well, to your point, I hadn't looked at the year-to-date performance for some of those key European indices up until recently, but they are having quite a year so far versus North America. But to me, it's always like that value versus growth conversation. If you are going to look at opportunity beyond, the mighty S&P 500, you talked about your weighting in tech. How much money would you be positioning towards global markets?
Well, so in our portfolios, we started with a 5% weight a year ago. We have a global fund that is ex-North America, meaning outside of North America. And it had just under 30% last year. It's up another 10 or 12% to start the year. Global stocks are roughly half the valuation of U.S. stocks. Part of it has to do with the sector makeups. Less than sort of 2 to 3% technology in European markets, right? And then lots of financials. Japan, a lot of financials and industrials. Latin America, a lot of energy and basic materials. But if you had 3 columns of global markets, the U.S. is half of the way down the third column for performance on the year, and that's because tech is underperforming and financials and industrials are performing quite well.
We're almost out of time this block, but the tariff tensions, trade, is that a risk for Europe or even the Canadian market? Like,
there certainly are risks. We don't know where tariffs are going to land. We're going to have to live with Trump bombs for a while, and so Mark is going to have to sort that out.
All right. Well, we're going to